Okay, great. Hey, listen, thanks everyone for giving me your time this afternoon. I'm Mark from Right Line Trading, and I really want to show you a really powerful trading system that I use every single morning in the trading room, in our live trading room. Quickly go to this disclaimer. All signals to trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are demonstration purpose only. Right Line Trading takes no responsibility for any participation by visitors or subscribers in the futures or forex markets or for any profits or losses that may be incurred. Careful consideration of your financial position should be made prior to trading. It should be understood that a person can lose a substantial amount of money. Therefore, the participation in these markets is not appropriate for everyone. Never risk more than 2% of your account on any trade. And those of us who are Right Line Trading are not registered financial advisors and not licensed commodity advisors. With that said, I'm going to first talk for a little bit about the oscillator. I'm going to move fairly rapidly because I do have a lot of information to give you. I think a lot of it is going to be information you've heard before. The first, again, is about the oscillator. Now, George Lane created it in 1957. Now, what he did was he created it solely as a tool to look at divergence. He did not create momentum to look at a trend or to try to track a trend. Now, momentum is considered to be a second-order derivation. And what that means is it's looking at the change in velocity or the change in speed of price. To give you a little bit of an analogy, if a car is moving around a racetrack, say at 100 miles an hour, and not accelerating or decelerating, its momentum is constant. If it begins to accelerate to 110, 120, 130, then momentum is increasing. So the rate of change of speed has to be either positive or negative in order for you to calculate, in order for there to be a change in momentum. Now, he felt that since momentum was a derivation, it was going to lead or foreshadow what price was going to do. So he looked at bullish or bearish divergences solely and traded divergence signals. Now, this was, remember, back in 1957. Now, George Lane was a really brilliant mathematician, and I believe back in those days, he probably did very, very well with his indicator. But things have changed. Now, again, we're looking at the rate of change of speed of a financial instrument. Now, let me show you quickly what a stochastic oscillator's formula looks like. Because stochastic relative strength, Williams percent K, all use this basic formula, and they're all variations of the same theme. Understand this formula, you'll understand exactly what stochastic is doing when it prints out a percent K on your trading chart. Now, C is the most recent closing price, and the price is compared to the average previous 14 lows or the average previous 14 highs. You know, there's a 14 low moving average and a 14 high moving average. And as the close approaches that high moving average, you get momentum to the upside. And as the approaches that 14 period low of a move, you get momentum to the downside. So back in the day, what George Lane was looking for was this. Price accelerates up to here and creates this amount of momentum. Excuse me. It then retraces. And when price accelerates up to here, again, excuse me, it accelerates up at a slower pace. You get less momentum on this move up. And he believed that because price approached this high more slowly, it did accelerate up, but at a more pace than it accelerated up here, price was going to collapse. And you can see that price here tried to accelerate back up to this point here, never made an equal high. It made an equal degree of, it created an equal amount of momentum, but then price collapsed. So he was looking at the rate with which price rose into a move. Now, this is a slide that I created. And what you see here is price moving up higher, but not faster. So what you're doing is price equaling a higher high, but momentum equaling an equal high. If price moves higher, what you want to see is it accelerate up here faster. If it accelerates up to here at the same rate, it accelerates up to here, you have divergence, and you can see it foreshadowed a big drop in price. Now, back in 1957, there was no institutional money present in the market. And the stochastic oscillators, there's a very old slide I got off of Google, and you can see that every time the oscillator crosses the 80 line, which is overbought to the downside, you get a short signal. Every time it moves up above the 20 line, which is oversold, you get a long signal. Crosses above the oversold line, long signal right here. Above the oversold line, you get a long signal. Now this one failed, but here's a cross of the oscillator line or the %K line below the 80 line. It comes out of overbought territory and heads down, creating this nice short opportunity. Comes back up, the long opportunity. Now, everything has really changed in the market now. And we all know that the oscillator can be overbought for a significant period of time, but price continues to rise and rise and rise. And what's changed? And what's changed is this. When oscillators were first developed, and this is true of many, many other indicators, and I want to talk to you about those. When oscillators were first developed, there was general volume in the market. And the supposition that you could make was essentially the power of each individual buyer was equal to that of each individual seller. Because there was no big money player in the market, like institutional money, to come in and completely skew the way price was going to move. Back in those days, this later divergence signal, I would imagine, was probably very accurate. But this is no longer true because institutional volume now dominates and determines the direction of price. Now, position that the power of each buyer equals the power of each seller made before institutional money played such a big role in the market is really some of the major driving forces behind Japanese candlestick formations. Now, Japanese candlestick formations are still important, and I look at them carefully, and I like to have them augment my trading when I trade. But institutional money destroys these candlestick patterns. If back in the late 1950s and 60s and 70s, before institutional money, if there was an intrinsic harmonic in the market, which Elliott was looking for when he created wave pattern, that's now been completely disrupted by institutional money. I mean, when they step into a trade, they're going to destroy that Elliott wave pattern. So it's really, I think, rendered Elliott wave very ineffective. Now the other is, and I say this with a lot of trepidation, because I know there may be a lot of fib advocates out there, but the same is true of Fibonacci. Now, I don't know how he adopted Fibonacci from a guy who created them 400 years ago, but Fibonacci support and resistance is only going to be as good as institutional money allows it to be. What we need to do is track institutional money, track its footprint in order to trade profitably. And if we look, which are telling you out into the future, different support and resistance levels, they're going to be tough to track, and they're going to be highly inaccurate in the middle of a big institutional move. And I can tell you that big money doesn't look at the fibs on your trading chart. So now, in this era of institutional volume, how should you trade the market in general, and how are you going to trade the indicator? And you have to make certain suppositions, and I hope this really changes the way you look at the market. There is no such thing as overbought or oversold. I mean, this is now a fallacy. The market is going to become overbought when the institutional traders decide that it's overbought, when it will stop going up. There's no mathematical way to calculate oversold. The market is going to reverse off a bottom when institutional money steps aside on a move. Markets are going to reverse direction only at the whim of institutional money. So our goal is to track it, not to try to forecast when they're going to step aside. Now, what's still in operation is we still get a reversion to the mean. And by that I mean, if you use a 50-period moving average, there's always going to be a mathematical pull on price to come back to that mean price, because that's the average price of the last, or if it's a 100-period moving average, back to that last average 100-period closes. But you're not going to get reversion to the mean until institutional money steps aside. And then price is going to snap back to the mean fairly quickly. The further out institutional money takes price above the mean, the quicker it's going to snap back. So trading divergence is tantamount to trading against the flow of institutional money. And you and I both know that trying to trade divergent signals in today's market is really almost impossible. Sometimes it works and sometimes it doesn't. Of risk on a trade, and it's just a toss-up. You have to put that type of signal aside. The only thing that we can do is trade in the direction of money flow. So we have to look at the oscillator in a different way than it was looked at a few decades back. We have to pressure as assessed by one of the oscillators, completely ignoring any potential divergence signal. And with it, you're indirectly footprint of big money. Just excuse me for 1 second. There's a lot of different oscillators out there, and I'm going to compare how they work in a second. But what we've looked at to assess momentum on a trade and to track the direction of institutional money is the Laguerre oscillator. It's got multiple inputs and a formula that's quite different than the standard oscillator. It's got a gamma, which we set, and it's got multiple filters, which we've also set. So what we've done with the Laguerre is to give it stability and at the same time give it speed. And you're going to see how in tracking momentum and telling us when there's significant buying or selling pressure in the market. Now, these are just a few examples. These indicators that I'm going to show you today are operational on any financial, any time frame. If they're not, then there's something wrong with them. If they're not tracking a force that's universally operative across any instrument in any time frame, then we've got a problem. So 30-minute cues. The blue line here, the magenta line, is the Laguerre. And what you're going to see is when they're above the 20 line, you get an arrow printing on your chart. It's going to print intra-candle, and it's going to stay once the candle closes. So we're now going to be trading in the direction of Laguerre momentum, long. Now, back when the oscillator locked long, we would look to fade the market. But what we know now, and the way we've tailored the Laguerre, is that buying pressure is so strong, it's locked the Laguerre above the 80 line. And only institutional money has the power to do this. So as long as this line is green, we continue to trade this instrument long. We never look to fade it. And you can exit on this down arrow when the Laguerre crosses below the 80 line. Now you may hear some noise because they're doing some construction on the building, and I apologize for that. It's the same thing here. When the line locks green, you can only trade this long. Now here's a better example. Here's the Laguerre crossing. The arrow is going to come up on your trading chart and then print. You can take the trade short as the Laguerre momentum falls. But then once it locks short, you've got tremendous selling pressure in the market. And only institutional money can create that selling pressure. And so we're going to stay in this instrument short as long as there's such significant selling going on in the market. You can see this is a 1 minute, a 1 hour chart of the cues, and this is a huge move. And it spans 3 days. Same thing here. There's the long arrow. Momentum on the Laguerre is shifted long. Then it locks long. We continue to trade this instrument up. You could exit on the down arrow or a break of support. As long as you trade in the direction of the Laguerre, you're trading in the direction of institutional money. Here's a future. There's the cross of the 80 line, the arrow, the lock short, and we ride this instrument down. This is crude, all the way to the bottom, exit on the up. Short signal, drop below the 80 line. Then the gear locks short, and down we go. Now, I want to compare the Laguerre to the stochastic. Now, the Laguerre is meant to track the direction of institutional money. And when you get this up candle and these two up candles, this up candle and this up candle, and I want to watch my time here, you're shaken out of the trade by the stochastic. You see it comes up above the 20 line right here, you're out of the trade. The Laguerre stays locked short. And it keeps, and it's tracking the fact that there's still significant selling pressure in the market. Because of the way it's been formatted, it's going to put you in the trade all the way down. Now, who's taking these long trades? These are traders taking oscillator divergence, MACD divergence, trading off of Fibonacci support. Maybe they're looking at Elliott wave or even Gann theory. This market is ruled by institutional money, which creates massive selling pressure to the downside. It locks the Laguerre down, and we can only trade this market short. Any attempt to counter trend trade this market is going to get you run over and beaten up. Now, I'm going to move past here. I mean, this is essentially exactly the same thing. Now I'm going to talk about the multi-time frame Laguerre when we get to the trading chart, and I don't want to run out of time. But we also not only do an assessment on our trading chart, but we do a multi-time frame assessment right above. And when you get a move down and a counter trend pull up here, two traders going, a bunch of traders trying to go long, you're going to take the move back down in the direction of institutional money. Same thing here, down. So let me take this out because I want to have time to go over order flow with you. I'm going to have to do it very, very briefly, but the indicator also, or the system, also does an assessment of order flow, but it's order flow done very, very uniquely and just in a different way that I think you may have ever seen before. Just let me get those slides up. It's a little bit late here. No, it's a wrong one. Hang on one second. Here it is. Now I'm going to have to do order flow very briefly. Hang on one second. All right, we're getting it up. It's opening up. Let me move it over. And let me move down to the slides we're looking at. Now, here's a market delta of a candle. This is a green market delta. Now, it's a little blurry, but it's 29.85. And what it does is show you that there's a predominance of buyers on the trading dome. Now, all this does, each of these tick levels adds up the number of buyers versus the number of sellers. If there are more buyers than there are sellers, it creates buying pressure. The market delta simply calculates the disparity and creates a number. Now this is green, it's positive 29.85, we get an up candle. The problem is that sometimes a positive market delta is associated with a down candle. And therein lies the rub, so to speak. Not every positive market delta creates an up candle. And I can tell you the reason why. Now, here's just a series of candles. And this is the way most software tracks market delta. They make the assumption that if the bid-ask disparity of a tick level or the total disparity of a candle, the delta, is up, the candle is going to close to the upside. And that's simply erroneous. So the fact that this line is increasing in magnitude, which is simply an increase in the positivity of the market delta, doesn't mean that the candles are closing to the upside. So it doesn't give you any predictive value as to what's going to happen on the right edge. You can easily get this, see this positive 222 gives you a down candle. So how can you use the market delta to give you an idea of where price is going to move out into the future? Now, the only way to do that is to throw out the outliers. Now, one standard deviation's worth of data works, and all the outliers have to be removed. And the outliers are where you get a down candle or an up candle on a negative delta, or you get a down candle on a positive delta. That's a 1464 positive and a down candle. So let me just explain to you quickly why you can get a down candle on a positive delta. And it goes to the aggressiveness of the buyers and the sellers. Now, there's some systems that look at commitment of traders, which is simply the tick value that has the most volume. I'm telling you, the COT or point of control of each candle doesn't have much predictive value whatsoever. We've looked at it for a long time here at Rightline. A lot of the things that you see with order flow and the volume ladder simply are not going to be able to predict with enough precision where price is going to move out on the right edge. So what we do is we look at the two higher time frames than the ones you're trading. It doesn't matter what kind of candle you're using. We use a Uni Renko candle. You can use a time, you can use a tick. If you're using a 2-minute, we're going to look at the 6-minute and the 18-minute. If you're using a 5 range, we're going to look at an 8 range and a 13 range. If you're looking at a tick chart, we're going to look at the two higher multiple Fibonacci tick levels. And what we do is we place the market delta of each of those values into a 15-period SMA. And that smooths out the data so that it throws out the outliers. So when both 15-period SMAs are sloping up, we know that the bulls are firmly in control. And that's never going to happen unless institutional money is involved in the trade. You can't get these two higher time frames to align unless big money is involved. Because by its very nature, the market wants to chop. And when both 15-period SMAs are sloping down, the bears are firmly in control, and we can only trade short. And when the two 15-period SMAs are not in agreement, we can't trade. So it defines chop. So it's a very, very elegant assessment of market delta, creating a really unique order flow assessment that provides an absolute direction for you that you have to trade. So if that Laguerre oscillator is locked long, it's green and locked at the 100 line, and there's so much buying pressure, chances are both of these SMAs are going to be heading up, and you're going to get a signal that tells you institutional money is creating tremendous buying pressure, and we're going to look for a long entry. So these are all leading indicators. They're going to tell you where price is going to move out along the right edge of your chart. They're not lagging because their assessment is made off the higher time frame charts. If any indicator assesses data from your trading chart, it's not going to provide you with forward-looking ability. So this order flow line, or those two SMAs, the slope from the two higher time frames than this trading chart. I purposely removed the time frame, moved the instrument, because it doesn't matter. When price heads down and order flow is turned green, price is going to rise. When order flow turns red, price is heading up, it's going to drop. Price is coming down, order flow is rotated, you have to trade long. And all these traders taking these counter trend moves, all they do is help us trade. Because as we go long, we're going to stop these traders out, and stopping them out, they have to buy their contracts back, and they're going to help push this move up. Same thing here. Order flow leads price. You see that happening over and over again. This green line is an absolute direction you must trade. And it's going to create that turn before price does, and up you go. Yellow, you stay away from the market. When the line is red, short, and when the line is green, long. And again, I want to emphasize, it doesn't matter whether you're trading a stock, a future, or a Forex market. It doesn't matter what time frame you're trading. Those are all irrelevant. And if they were relevant, what's important for you to know is it would mean that there's something wrong with the system. Because this has to be a force that's universally applicable to the movement of price on any financial instrument. It only works on stocks, but not on futures, or one time frame and not on another. Then we really haven't harnessed a true force that really determines the future direction of price. And when it keeps changing color, you can see it defines chop. And when it turns green, up you go. Now, I'm going to come out of this, and what I want to do is I'm going to create a chart. Just hang on 1 second, and I want to show you the system live. I'm just hang on 1 second. It's just going to take me 1 minute. I was trading so long today that I got into the room 3 minutes, basically right at the last second. Hold on 1 sec here. Okay, let me create that chart. Hang on 1 sec here. Let me just get my control panel and bring up a new chart. And I'll show you a really choppy market. I'll show you the NASDAQ. Now here's the NASDAQ. What I'm going to do, I'm going to load the template. Now here's the system on a live chart. Now let me show you a couple of things that we've done to sort of change it a little bit, and a couple of additions, and I'm going to have to mention them really fast. First of all, as a special, we're going to give you this pivot indicator. This pivot indicator is really unique and extremely powerful. I'll give you an example. Pivots are created off a candle body low and a candle body high, not off a wick high. And this is simply Japanese candlestick dogma. A break of the pivot occurs when 2/3 of a candle body closes above it or below it. That's how this pivot indicator operates. And price really obeys it. Price comes down here, hits it, and bounces. Whoops. Hits it and bounces. Hits it and bounces. And then when you finally break the pivot, which is right here, you get a tremendous shot, because what you're doing is you're stopping out all the residual buyers in this pivot. So it's a tremendously powerful indicator, because it actually sits at where all the buyers are sitting here on support and where all the sellers are sitting here. And we accurately assess when a pivot is actually broken. The other is, this is a 50 EMA of a 50 EMA, and this is a 15 EMA of a 15 EMA. Now, the other modification is what we do is we project the results of order flow directly onto the candle body. So the first line is the order flow line. That's the multi-time frame assessment of the market deltas of the two higher time frames. And because every time the candle is haloed in magenta, I know that order flow is to the downside. And every time the candle is haloed in blue, I know that order flow is aligned to the upside. I can make my order flow line invisible. Now, I just want to show you that order flow, you can decide what up color and down color you want. You can also determine the thickness. But I'm going to take the order flow line, which is line number 1, and I'm going to make it transparent. And the reason I can do that is because I'm getting all the data on the candle halo. So now I only have to deal with 2 lines. And I have to look at the candle halo. And to give you an example, here is a perfect short trade. We get a break, whoops. And these are very, very high probability winners. You get a break, and you see how you get you see how you get the pullback on the wick? It shows that buyers have tried to turn the market right here. That's a bull failure. We see the candle is haloed, order flow to the downside. Now this is our chart Laguerre, and here's our multi-time frame Laguerre. Remember, we never do an assessment based on one time frame. When the chart Laguerre has come into sync with the multi-time frame Laguerre, you've got tremendous selling pressure. Order flow is aligned to the downside on a multi-time frame basis. And you've got yourself a really nice short trade. Now you can decide whether you want to take the trade off at the pivot or just tighten your stop or let it roll, but that's a 10.25 point move on the NASDAQ. Now you have to wait for everything to align here and here. Yeah, this is another winning trade right here. Now, see, this is censored because you don't have order flow aligned in your direction. This doesn't have the multi-time frame assessment. And here's your trade. There's the arrow. That tells you that the gear on your trading chart is heading up. The multi-time frame is already locked green. That's what we're looking for. The trading chart gear to start to march in the multi-time frame direction. Candles outlined in blue, order flows in our direction, and we have a huge move up. Now the alignment doesn't occur that often, but when it does, it's extremely powerful. Right here, you get it again. You want the chart to be heading up, and we want our multi-time frame locked green right here on this pullback. There's a winner. Well, you can't take this short roll. You can't take this trade. You can take this pullback here and this continuation. And what this does is it censors out almost every loser. Every system looks at all the winners, but doesn't look at potential losers. Now I'm running out of time, so I'm going to stop here. Now here's another trade right here. Whoops. I want to show you the offer, and then I want to take 1 minute to answer questions. There's your trade short. Now, I was only able to show you the NQ. If I censored the NQ and put up the Qs, or put up Google, or put up the pound yen, it would trade exactly the same way. When the candle is haloed in the appropriate direction for order flow, and the chart gear is moving in the direction of the multi-time frame, you've got yourself a trade that's likely to work 80% of the time plus. And let me quickly show you the offer. It's $7.99. It's lifetime license and upgrades. Now, Gary doesn't have his trading room up yet. You're going to be in the trading room with me for a month. You're going to get a 10 module weekly educational training session all at one time. You're going to get 450 video tutorials, and the first 5 are going to get the pivot indicator for free, which is a really powerful additional indicator. Now let me quickly look at questions. I've got 60 seconds to look at questions. Hang on. Hey, Wouter. Thank you. Well, thank you, Nick. I think we do. I'm sorry if I was breaking up a little bit. You know, they're doing a lot of construction on the building, so that's the problem. I know that's the reason for the breaking up, Gary. Normally our audio is perfect. The indicators work on Forex terrific, Douglas. It does not matter. I mean, Forex still has a bid-ask side on the dome. It's still going to create a Laguerre configuration, and it works terrific on the Forex. You do need Ninja to use the software, Tom. But if you have Thinkorswim, it will power Ninja, and you can take the signals on your Thinkorswim platform. But you'll be running a free version of Ninja. So that's one way of doing it. But it works on NinjaTrader 7 and 8. The URL doesn't work. It has 2 periods in a row. Hey, Rory, our URL doesn't work. There are 2 periods in a row on it. Okay, we'll fix that, Cross. Well, listen, I'm a minute over. You'll be in the trading room with me. We make money almost every single day in that room. And if there are any questions about trading methodology, trading entries, then you're gonna have a month to. You'll have no problem. So thanks so much for coming aboard, and thanks for the couple of minutes extra. If you have any questions, just give us a call, 786-713-5276. 786-713-5276. Or here, go to our website, rightlinetrading.com. You'll get our phone number there. Thanks so much for giving me your time.